Audit planning and framework. Planning. What is planning? Planning means strategies that involve expected nature, timing and extend on audit. The importance of the planning is because it can avoid misunderstanding. Planning also minimize legal liability and also it conduct audit efficient and timely manner. It also keep audit cost at reasonable minimum level. Pre-plan client acceptance. First we are going to look on pre-plan client acceptance. These are the procedure regarding new clients. The first procedure is to obtain and review information about client's business and industry. It will help the auditor understand the nature, type and need of the client. The second procedure is reviewing client's financial report. It provides the auditor the overall view of the client financial activity. Next, inquiring banker, lawyer and other resources about the client reputation. The last one is communicating with the preceding auditor. Moving on, continue client. These are the procedure for prospective client. First is integrity at those in charge with governance. Second, obtaining and reviewing financial information. Third, information from third party that is legal advisor. Fourth, communication with predecessor auditor. Fifth, evaluate audit's firm independence and ability to service the client requirement. Next, procedure for evaluating existing client. The first 5 procedure are same with procedure for evaluating prospective client. These are the additional circumstances. First is the major change in management, director, legal advisor, financial condition and nature of the client. Second is scope of the engagement. Third is business risk. Engagement letter. Next part is the scope of audit work. What is an engagement letter? It is the agreement letters by auditor's firm to his client before the commencement of his assignment. The engagement letter's purpose. The engagement letter's purpose is to confirm the acceptance and form of audit report. Next, it is to clearly defines the auditor's responsibilities and objectives, also the scope of audit. The engagement letter is needed because it will protect us from legal liability, and lastly it is to avoid misunderstanding between auditor and client. Engagement letters contents our objective of the audit, financial statement, scope of the audit, responsibilities of client's management, auditor's right to access, form of reports, deadlines and audit fees. Auditor do not need to send letter each period. However, there are reasons for the auditor to send a new letter, such as if there any indication that the client misunderstands the objective and scope of audit. Also, if there is any revised or special terms on the engagement. Next, if recent change of senior management, board of directors, or any legal requirements. Fraud and error. Fraud means wrongful or criminal deception intended to result in financial or personal gain. Error means a transaction wrongly recorded but did not have any intention to do it. Setting audit objectives. Auditors needs to obtain evidence that supports each of the assertions for every material components of the financial report. Management's assertion. Management assertion refers to expressed or implied representations by management are reflected in financial statements. In other words, assertion means strong statement. Categories of assertions. There are 3 categories of assertions. First, assertions about classes of transactions and events for the period under audit. Next, assertions about account balances at the period end. Third, assertions about presentation and disclosure. Preliminary analytical procedure. The purpose of preliminary analytical procedure are assist in planning the nature, timing and extent of audit procedures, to identify potential errors, to determine areas that require detailed checking. Materiality. It is a criterion for determining the items require attention and detail examination. AUD320 states that information is material if its omission or misstatement could influence the economic decision of users. Nature of materiality. There are two natures of materiality and we need to consider both qualitative and quantitative nature. Examples of qualitative aspects that affect materiality are wrong use of accounting policy, misstatement, fraud. Knowledge of client's business risk and industry. These factors, which are industry, regulatory environment, use of information and technology, nature of entity, will increase. These factors helps the auditor to focus which area he needs to be concerned and what to audit. What does it has to do with the industry and external environment? There will be risk with a specific industry and also risks to the customers. What about the business operation and processes? In business operation and processes, it is based on how the company finance their operational activities and sources of financing. Now let's move to client's business risk. Risky is defined as a situation involving exposure to danger. These are the factors that will cause business risk: industry and external environment, business operation and processes. Those business risk will lead to audit risk. Audit risk. Audit risk is the risk that the auditor gives an unmodified or unqualified audit opinion when the financial report is materially misstated. There are two types of business risk by an auditor. The first one is auditor's business risk. The sample are exposure to loss or injury from litigation, adverse publicity or other event arising in connection with the financial statement. This risk cannot be directly controlled. The second risk is audit risk. This is the risk auditor give inappropriate audit opinion on financial statements that are materially misstated. Audit risk can be directly controlled. There are three components of audit risk. There are inherent risk, control risk, and detention risk. Inherent risk gives susceptibility of insertion material misstatements in the financial statement and the absence of internal control. Control risk is material misstatement will not be prevented or detected on timely basis. Control risk can be assessed to segregation of duties and inherent limitation of internal control. Detention risk is a substantive audit procedures performed will not detect a material misstatements that exists in the account balance of the class's transaction. Detention risk can be assessed to decide on nature, timing and extent. Here are the steps to minimize audit risk. First, plan and delegate audit with due care. Avoid misunderstanding with clients. Next, use audit manual. The audit evidence are properly documented, and lastly, the audit fee should be based on work done. That's all we can explain about audit planning and field work. Thank you for watching.